It's Matty, your Secretary of Mortgage, and it's time to get presidential on the next episode of
Remember when?
With the explosion of real estate values, Airbnb, and owning rental properties as the next form of income, I created this video to share with you some good old-fashioned know-how about the pitfalls and opportunities when financing real estate. Ready? Here's a good one. Remember when President Trump said this?
You don't learn anything about somebody's wealth with a tax return. You learn it from statements.
Love him or hate him, the man is right, especially when it comes to the mortgage business and financing real estate with a loan, because tax returns don't always tell the story. People that generate their income and wealth from real estate usually don't show great income on a tax return. Why? Because that's the name of the game, using real estate as a way to reduce your tax liability and sometimes create a loss purposefully. This is how the tax code is wrote, but be aware of it, how it can cause a problem for you when getting a mortgage, because the rule of thumb for rental properties usually requires a review of the 2 most recent years of taxes. Although owning real estate is passive income and can be a great form of mailbox money, lenders will consider you self-employed and require tax returns. Also, a 2-year history of owning real estate is a necessity to use this type of income. Most clients will counter and say, "Can't you just see the income on a bank statement?" Although this is true, banks prefer a format to baseline the income via the most 2 recent years. Moreover, if the income is an increase year over year, that income will be averaged. Now, if the most recent year of the 2 is lower, the lower of the 2 is used, not the average. A common qualifying feature for most lenders is the add back of depreciation, which in most cases can reduce or neutralize any loss. Sometimes this will actually create income or cash flow to the property, but keep in mind, depreciation is an accounting tool. It's not a true expense, say like your property taxes. No one writes a check for the depreciation of the property. So far, so good, but remember, lenders can become very picky with how they score your income, and it's not always the income less expenses. Here's why. Example 1, a lender I used to work for did not allow more than 25% of the total qualifying income to come from real estate, regardless of the number of properties, the history of the income, the amount of leverage or lack thereof. This rule would be considered an overlay to policy to reduce their risk appetite for clients with this type of income concentration. Remember, overlays are lenders' way of saying thanks, but no thanks. And think about it. If your tenant leaves or refuses to pay like they were permitted to during the pandemic, this can put you in a very tight spot. Another example, during the pandemic, a major lender refused to use real estate income of any kind, residential or commercial, long-term or short-term, due to this rent mortgage moratorium. Now, today the rules have reverted back to the norm, but it's important to understand these rules and how they can cut you off at the knees just because they don't like your format of income. During this period, this lender didn't allow any income from real estate of any kind. You could have made $1 million annually from your property. They gave you 0. You're flat out rejected. In relationship with this lender didn't even matter. Some people start with a local bank, which is fine, and in most times could be a great fit. But in crunch time, this could also be a hard stop. So here are some ways to avoid the stiff arm. By far the best way, leverage experienced originators. If you're going to stay in your lane and start with your friendly bank, make sure they don't just send you a guy, but one with experience, good experience, self-employed experience, because self-employeds have the hardest time obtaining mortgage credit. Hopefully this individual can read the tax returns, of by which most cannot. And it's not to blame them, it's really the system. For the past 2 decades, banks have done a terrible job of teaching their bankers how to read these critical instruments. Next, leverage a PFS. Make your mortgage process great again by preparing a financial statement. Usually not a requirement within your needs list, but sometimes this statement will include other info and assets you can leverage. Like any other piece of documentation you provide, this can contain other ways to score income to add to or offset a reduction in your earnings, say like the most recent year rule, or provide another income stream altogether. Assets can be used as an income stream, but how will be determined by that lending institution. Some banks may take your total liquid assets and divide it by 360 months, much like a Fannie or Freddie will do. Some may use the assets as long as it's, say, 3x the loan amount, while others use a custom calculation based on the type of asset and the age of the client. Other times, it just may depend on the loan amount itself. Since most mortgage originators can't read tax returns, they're only going to ask for this information once it goes wrong. And then you're going to be in a great game of red light, green light. Also, leverage the DSCR. With the Airbnb explosion, a new faculty has come to the scene known as the debt service coverage ratio, known as the DSCR loan. Though not widely available at most banks, they are available through mortgage companies and brokers and are great tools for investment purchases as it simplifies the qualifying on the subject property via analysis of the market rents versus the carrying cost on the property, also known as the PITI HOA. Most lenders want to see a ratio coverage of 100 or 1, meaning that the down payment is enough to offset the carrying cost of the loan. An easy example of this would be to say, perhaps you're looking at a house with a projected mortgage expense of $500 monthly, with taxes of $250 monthly, followed by, let's just say, $250 of insurance and dues for an effective monthly total of $1,000. If the rent was $1,000 a month, this ratio would be 1, or the rent equal to the expense. The DSCR works great for investment. It's a standalone analysis based on that individual property. You could own 10 or 100 other properties or a whole portfolio. It won't matter. Great, but what if it's a house you want to live in? If it's something to occupy, leverage bank statements. There are loans made available that will review bank statements as a form of qualifying income. Income will be reviewed based on a year or possibly 2 years of bank statements, personal or business, analyzing the deposits and averaging them over the time period. Usually you're going to get these loans at a premium rate, but it might be worth it considering the format of the income or the reduction in documentation. If there's a substantial amount of down payment, this may be the way to go. See, there are many ways to skin the cat. But first, make sure your lender understands your income and how it works holistically. And 2, confirm they have a great product menu. You don't want to be left without options. And finally, don't let them cut you off at the knees or get frustrated simply because you own real estate and your most recent year of taxes doesn't look the best. In this business, there are only solutions. God forbid, ask your lender to get a shovel and dig. Understand the income, how it's earned, the format, the frequency, because often this changes, and yes, it matters. Think, if you're a self-employed business person and you typically file an extension but happen to go buy a property in August, almost 20 months have gone by without formal income documentation. If you're earning the income on a Schedule C versus a partnership return, it matters too. Why? Because taxes don't always tell the story. And let's not forget.
And when you add it all together, a lot of good things are going to happen.
Thank you.